How's it going, everyone? It's Sam. Today we're talking about IIPR, or Innovative Industrial Properties. It is a very interesting stock because it is the only one in its realm. It's the only MJ REIT. So I have to be cautious about what I say, about how I say it on this channel so I don't get demonetized. But you'll understand if you don't already understand what that means. You'll understand it a little bit later. But they are the only REIT right now that is out there that works with medical Mary Jane facilities and is a very successful one at that. So I'm going to talk to you about how I decided to invest in it, my returns with it, and then what to look for going forward and why I found it so exciting because I have over 100% gain in IIPR. So if you guys like this, please leave a thumbs up. I really appreciate it. I have to be careful about how I talk in this video because YouTube does want to create content and wants to support content that is very ad friendly. And, this topic is still up for grabs for some people, whether it's appropriate or not. So if you guys like this, please leave the thumbs up. That helps out a lot. I'm going to have to say MJ or some variation of that a lot during this video. Also, if you want to support in some other way, you can check out the link down below to WeBull or M1 Finance, either of which you can invest in IIPR with, or even SoFi Invest or SoFi Money. I actually first found out about the stock because I got it as some free shares on SoFi Invest. So definitely consider clicking one of those, get some free stock, and then buy some IIPR. So IIPR has been on a tear. I bought it around $70 a share originally. I sold it when it went up to like $100 a share. Then the pandemic hit. I bought more because it fell down to under $50 a share. It fell down to $46. And now it's $153 again. Now they pay a very nice dividend too, which I'll go over later. But first of all, I just want to show you what I have. So I do have a share in my WeBull account, but the majority of my IIPR is right here. I kept on telling myself I should buy more IIPR in this portfolio. This is my Roth portfolio. And I kept on telling myself I should buy more, but it kept on going up. It kept on going up. So I bought other stuff like Tesla, like Foot Locker, like Berkshire, like Store Capital. And while those other ones have done quite well for me, IIPR has returned me about 120% since I bought it. So I own about 7.5 shares at $70 a share. It's worth $155 right now. And I was able to gain a nice little amount there. Now, I will say too, I do have some extra in my other portfolio. I've been buying it in my dividend portfolio. If you've been watching our dividend series, you can see here that I own about $200 worth. And I do really like this company. So first of all, if you don't know what they are focused on the acquisition, ownership, and management of specialized industrial properties leased to experienced state licensed operators for their regulated MJ facilities. So just thinking about it, right? This is how I started to think about this company. A lot of major banks won't lend to these kinds of companies. So I worked at a bank for 2.5 years. I saw this right away when I started working for the bank before I even knew about IIPR. A lot of banks work at a national level, and a lot of these types of companies are kind of blacklisted from national banks for the fact that it's still illegal nationally. A lot of the time there's a lot of backlash on recreational or medical, both of them. Some people don't believe in it, so a lot of these big banks won't even touch it. So I worked at a regional bank, which typically has a little bit more lenience on that kind of thing, but we would not touch anyone that even made a product for anything that was related to the industry. So by that I mean we had someone that was making a product that would go into a vape that could be used for MJ, and we wouldn't work with them. So that is something that I noticed very early on. So I started to think, okay, well, these companies need money, especially because they're trying to expand. They need some kind of scale to be able to support their ventures. So a lot of the time they need money to be infused into their system. And the best way to do that is for them to sell off the facility that they're using and then just rent it back. They're going to expand. They're going to make a lot more money down the road. So it's better short term to just do that and rent back from the facility. So you might have to pay a lot more, but it might be worth it long term just to be able to get to a higher scale. So IIPR will buy these facilities from the companies and then rent it back to the same company that had it originally. So it's very low turnover because these facilities oftentimes are created very much for these companies. They already are situated there, they already are growing, they're already successful businesses a lot of the time, and they just want to expand. And you can see here that in September 21, 2020, they owned 63 properties and they were 99.3% leased based on square footage. So they have many facilities throughout the states. And this is a company that is very lean and mean. So if we look over here, you can see their investor presentation: 63 properties, 5 million rentable square feet, 16 states. The average lease length is very long at 16 years. And they do something called triple net leases. So a triple net lease is where the lessee or the tenant pays for all property tax, building insurance, and maintenance. So they do that along with paying for rent. So it is a very hands-off way for IIPR to manage. So they only have a couple different expenses that they have to deal with. They also are able to make the tenant pay for a lot of those upgrades. And then they don't have to worry about the facilities for a very long time because their lease length is 16 years. You can also see here this beautiful, beautiful increase in dividends from 15 cents to 15 cents to 25, 25, 25, 35, 35, 45, 60, 78, $1, $1, 106, 117. Almost every single quarter, they are raising this dividend. This is a very rapidly growing industry too, because more and more states are actually loosening up on their restrictions on this, and it's going to be a bigger and bigger industry in the years to come. Now, I will hit on some different risk factors for IIPR in this industry, and I'll hit on those towards the end, but let's take a look at their income statement. So you can see here, total revenues in 2016 of about $500,000, went up to 6.4, went up to almost 15, then 45, now about 100. This is in millions. Their net income is also positive, so it went negative 7.5 to negative 100,000 to 7 million to 23.5 to 54. And one thing you kind of have to watch out for with REITs is that they oftentimes dilute shares. So if we actually look at the FFO per share, so the funds from operations per share, this accounts for a lot of the amortization and selling the property and stuff. This is a better indicator than something like net income. You can see that it is positive and it's going up to almost $5 a share, which is a good thing. That means that the price to FFO is about 30, not bad. I mean, this is a growth company, so you have to price that in for sure. If you look at their 161 million in cash and cash equivalents versus their current liabilities, including their accrued expenses and accounts payable, you're looking at a very good ratio. So they have about, let's just call it 30 in current liabilities, and they have about 161 in cash. That is a very good current ratio. And just again, looking at their dividends, it's a very nice increase that they have here. So far, they have not decreased the amount of dividends in any one quarter, and they do have a yield of about 3.2%. So this is a high payout ratio, but that's normal for REITs because they have to give out a certain amount. Now, there are a couple risk factors that I see in this company. First of all, just share dilution. You can see here that they increased the number of shares from about 3.5 million to 6.7 to 9.8 to 11 to 17 to 22. But the thing is, with REITs, a lot of the time you can just hold on and they can take some of their earnings and buy new properties, but that's a very slow way of going about it. And they're getting such good rate of returns on their properties that it doesn't really make sense. It makes a lot more sense for them to issue more shares and then to return shareholders more revenue. So that is something that they have constantly done, and that's why it's important to look at the FFO per share to make sure that we're not actually just staying at the same level and earning more revenue, but there are more shares out there. You can see that overall it's been positive. They've been able to increase earnings per share pretty well. Now, the other thing that I could see as an issue is just the fact that if MJ becomes more legalized, if more banks are willing to work with these companies, then it might be an issue going forward because the banks might just want to take a loss leader. They might be willing to remortgage these different facilities for a lot less than IIPR. For example, IIPR gets a very nice cut of revenue and really gets a good rental rate for the fact that they're the only company that's doing this really. But if banks get in the mix, they can charge a lot lower rates and the companies might decide to go with a bank. But one thing that's really good about IIPR is their average lease time right now is over 16 years. I think that IIPR is set up well, and they've been able to talk their clients into setting up these really long contracts, which is really good for the company. And I think it will take a while for the banks to start working with these companies, even if MJ becomes legalized at a national level, which will be awesome because I won't have to say MJ anymore on YouTube. I'll just be able to say the word like a grown up. But, I think that is another risk factor that IIPR could have some extra competition as it becomes more legalized. Let me know your thoughts on IIPR down below. I don't think that it's too expensive for where it's at now. I mean, it is a very fast growing company. They keep on raising dividends. So if you want to make this position in one of your dividend growth portfolios, or even as a dividend paying stock in a growth portfolio, it's been able to grow a lot this year. And I imagine that will continue to grow pretty fast, at least compared to the general market. Of course, I could be wrong. I'm not a stock analyst, but definitely do your own research. Check this stock out and let me know your thoughts below. Thank you again for hitting the like button. Thank you for checking out the link down below to get those free stocks through WeBull. And if you want to see a video on another growth stock, definitely check out this video here to ChargePoint or SBE. They are providing the chargers for these EV companies. Definitely a good stock to watch and a good stock to have on your radar. So definitely check this video out. Thank you, and I'll see you right here.